Welcome to Disruption Blueprint with Shannon Spotswood from RFG Advisory. In this podcast, we help advisors grow their net worth, build their businesses, and maximize their independence. We've built an award-winning platform with innovative technology, comprehensive service, and a team of individuals who are experts in their field to serve advisors. Join us for this journey where we explore everything that has to do with running an independent advisor practice as we bring together successful advisors, industry experts, and innovative minds who are on the bleeding edge to challenge the status quo, foster new ideas, and create a path for advisors to unleash their growth potential. Now, on to the show.
Welcome to Disruption Blueprint. I am joined in studio by RFG Advisory's Chief Investment Officer and Managing Partner, Rick Wedell. And virtually by Patrick Shaddow, who is CEO and President at Syntax. Welcome, Patrick.
Thank you. It's great to be here.
We are going to have some fun. Anybody who knows me loves that my first, pitter pat of my heart is all around investment management and portfolio construction. So I've been looking forward to this discussion with who I believe two of the arguably smartest, most innovative minds in institutional investment management, the two of you.
Well, thank you, Shannon. I appreciate that.
I'm your number one fan. I should have brought my foam finger.
Yeah, that's a great intro. Thank you. I wouldn't put myself there, but we do have a lot of good ideas, I think.
Well, what I want to do is to kick off the conversation, we're going to spend a lot of time talking about portfolio construction, investment management, how the world is evolving as it relates to advisors. So to set the stage, and Rick, I'm going to have you, tee us up here. Let's just take a pulse check on where we are in terms of asset management and the choices that advisors have today. The TAMPs that are out there, SMAs, UMAs, mutual funds, the absolute, proliferation of ETF strategies, direct indexing, alternatives. What's the lay of the land currently? And then I'm going to ask you about what is portfolio construction 3.0 and where are we headed?
So, it's really interesting if you think about the evolution of this industry. If you go back a long time ago, you had like a stockbroker, right? And that stockbroker would normally pick, individual securities to build out portfolios for clients. It was, you got a guy or most likely a guy, sometimes a gal, but most likely a guy, right? Yeah. And they were just picking, individual stocks. And then, we created kind of the mutual fund and we created all of these other products to sort of deliver investment management services for people. Each of them having certain advantages and also certain disadvantages, right? Mm-hmm. So, if you just think about the evolution of the ETF, tax efficiency there, very low cost, the evolution of the mutual fund, some of these new SMA type products where you can get some option overlays and structuring and, really taking a lot of different, what I'll call financial innovation and bringing that to the client either more tax efficiently, more easily digestible by the client at smaller dollar sizes, right? So, what previously only used to be available for like $1 million account is now something that you could do for a $100,000 account or maybe even a $10,000 account. And then, at just with incredible speed and tax efficiency. And I think that right now, if anything, the advisors' plates are very, very overcrowded with, potential solutions that are out there, right? You've got everything from, I'm an old school stock picker for my clients to I'm managing the managers to I'm just doing an index to, I'm using some of these innovative products on behalf of my clients. And, depending on where you are in that spectrum as an advisor, there's just a plethora of different choices out there. If anything, the amount of choices that are out there to be able to do things innovatively for clients is almost overwhelming, I would say, for most advisors as they approach the investment side of their business.
Patrick, anything you want to add there?
Yeah, I mean, Rick kind of nailed it, Shannon. I've this is probably the first time a lot of your, audience would hear from me, but, if you look me up, I've been kind of touting this for a while, the launch of the mutual fund back in the 20s, the proliferation of the mutual funds in the 50s, the back office paperwork crisis in the 60s, right? The launch of the first money market mutual fund in the 70s, right? The rise of discount brokers in the 80s, right? The ETFs in the 90s, 2000s, 2010s, and so on and so forth. And now, what you're seeing is frankly, with the advent of new changes in custodial practices and the advent of, technology platforms, um, it's going full back circle to those SMAs, right? And effectively, you can get all the benefits of indexation, all the benefits of actively managed portfolios, all through this, through SMAs and UMAs and at a fraction of the cost, right? And you get all the added benefits of tax loss harvesting. You get all the added benefits of customization. You get all the added benefits of, kind of, creating unified portfolios of private and public markets, all in just one kind of ecosystem. And so, it is a lot for the advisors, in terms of, all the options, right? I've been in the indexing business forever, since 2006, where I started at Dow Jones. And at a certain point, a few years ago, there's more indexes than there are listed stocks, right? And there's a $9 trillion ETF market, and a lot of that, kind of moved from mutual funds, and there's just continued innovation, and it's just going to keep going, right? There's no stopping innovation.
So we've bellied up to the bar of our all-you-can-eat Thanksgiving buffet. And I think you're hitting on a really interesting point about the overwhelming nature of investment solutions now being presented to advisors, though trying to solve what has been a consistent problem. How do I adjust the risk on my portfolio to meet the return objectives in order to satisfy my financial plan, live the life that I want to live in whatever complexity that looks like, from, large, complicated, multi-LLC trusts and estates and generational wealth, to I want to retire comfortably. So Patrick, Syntax has built 2 proprietary data layers that effectively map the DNA of companies, their revenue sources, their lines of business, their functional exposures, and you've done this on a global scale. The first time I met you and you explained this to me, it was my, Renee Zellweger moment of like, you had me at hello. Just a really interesting way to be thinking about the underlying data that leads to whether it's the construction of an index or an ETF or mutual fund or all the things that we're talking about. So that we bring everybody into the conversation, I think it'd be helpful for you to talk about Syntax, to talk about these DNA layers. And then I want, the two, Rick, you and Patrick, to just discuss, why does this matter? How is this starting to tee up a shift in the way that advisors can think about active investment management?
Yeah, I mean, from our perspective, it starts with our name, Syntax, right? What we effectively do is go company by company, product line by product line, year by year, and assign alphanumeric codes to the enterprise of a product line, the suppliers of that product line, the customers of that product line, the intermediaries within that spectrum, the resources that are used and acted on in order to construct those platforms. And when you string all those alphanumeric characters together, you have your own language, you have your own syntax, right? And effectively, what we're showing is the entirety of the value chain, up and down, so that you can reorient on any one particular facet of a value chain, right? If you're thinking about, say, for example, um, mining copper, right? Upstream of mining copper, you have companies like Caterpillar, right? Who are actually heavy equipment machinery that to do the mining, right? Downstream of copper are, the original equipment manufacturers, right? And so you can kind of keep reorienting around different, fulcrums, if you will. And by doing so, what we're ultimately able to do is cross-reference empirical market data with respect to how the underlying resources are trading, the commodities, how the stock's performance is during different types of macroeconomic regimes, right? And during different types of business cycles. And so, in terms of an active component, say for example, you hook up to let's say the St. Louis Federal Reserve Economic Database, right? And you can say, all right, what's the current state of the U.S. economy? And you can look at, the four major macroeconomic indicators of the dollar strength, or is it weakening? Inflation, is it going up or is it going down? Interest rates, are they going up or are they going down? GDP, is it expanding? Is it contracting, right? And what we can do is we can cross-reference all these unique alphanumeric characters that we have assigned to different companies and their underlying product lines, and see how those different companies do during different types of changes of everything that we just spoke about. And so, to bring in an active component here, say for example, Rick had a team of equity analysts where, his equity analysts were systematically looking at price projections of underlying equities, right? Where what we could do is we could cross-reference those price projections of these securities with respect to all this, macroeconomic data, with respect to all these, species of companies, if you will, to see how it changes and evolves as different market cycles kind of introduce themselves. So it's a lot to think about when you start thinking about the fact that what we've done is identified over 10,000 unique species of business models, right? But that's effectively what we've done. And we've done it through a coordinate-based reference data set where the coordinates are literally resources and activities, so that you can systematically say, all right, a company that, say, for example, is storing information using technology and real estate. Well, that would be ultimately a server farm, a data a data center, right? But if you were to take out a word like technology or storing or real estate, it changes, right? And so instead of saying technology, real estate, and storing information, let's say storing information using just real estate. What's that? That's a library, right? And then if you say, all right, let's remove real estate and reintroduce technology, what's that? That's the cloud, right? And so now what we're able to do using these alphanumeric characters is just better identify all the companies that have those same attributes, so that you can group them by any one characteristic, group of characteristics, or the whole value chain itself.
What that enables, right, from an investment management standpoint is, anybody at this point can go in and say like, well, I want to gear up either an investment strategy itself, because I think, hey, copper is going to outperform or whatever else. Let me use this technology to then select the security set that isolates that particular insight in a way that enables me to express it in a portfolio. And, the interesting thing about it is that, in decades past, if you were to try and do that, it would take you, a very, very, very long time. And even when you did it, you weren't exactly sure whether or not you got that calculation right or not. But, this type of technology enables you to make very rapid decisions with respect to what I would say, very narrow indicators of, like, hey, I want to play the fact that silver's price is increasing dramatically, but I don't necessarily want to own silver. Or I want to play the fact that I think that, the dollar is going to appreciate relative to the euro, or whatever it is, in a way that is very incredibly cost effective, right? And both in terms of dollars spent on the people that are doing the research, but also in terms of time. It's a very efficient way to express those portfolios.
Okay, so with all of that on the table, and I love, Patrick, one of the ways that you explain this to me is it is allowing investors, advisors to look under the hood of the entire global economy. So, Rick, with everything that we've just talked about, I think it would be I think it's important to understand how RFG thinks about institutional caliber investment management, and what does that mean? Why is that important to advisors?
Yeah. So we talked a little bit about how an advisor, like the number of choices are overwhelming out there. And I think a lot of advisors, particularly in the old school model, would do this sort of like, okay, I'm gonna do it myself, right? And even if I'm not doing it myself in terms of picking the individual funds, maybe I'm just gonna like outsource this to like a BlackRock or somebody else like that, where it's like, I'm just gonna Xerox a model portfolio, right? And the thing that I find a little bit challenging on that is there are investment products that for the right people are the right fit, right? Mm-hmm. So, as an example, if I just think about annuities, right? Tommy Williams always used to say, like, the guarantee in an annuity isn't too good to be true, it's too good to be free. And so you look at annuities, right, which were essentially designed for clients that just for emotional reasons, did not want to take the actual risk associated with the marketplace, right? Mm-hmm. Like, even though you could run all the math and say, like, look, you're probably better off in a 60-40 or something else like that. For some clients, they just can't take that level of risk, right? And over time, those annuities have kind of evolved into a number of products that offer the same sort of like, I've de-risked, I'm still giving you some amount of market exposure, but I've de-risked that, right? I mean, structured notes as an alternative to annuities. You've got, call strategies that are, and then just most recently, you have buffered ETFs that effectively accomplish the same thing by establishing, a defined payout in a very sort of low-cost option. And I say all that to say that if you're an advisor whose toolbox has always been sort of like, well, I've got my 60-40 portfolios and I've got my annuities, and those are the only two tools that I'm using, you're missing out on a whole lot of evolution of what investment management allows for clients these days. And so as we think about institutional asset management, what we want to do is I want to empower the advisor, give the advisor the team, right, to be able to interact with, so that when an advisor encounters that client and says, here's the client situation, this is what we're looking for, they have really a team of dedicated professionals that are like, okay, like, well, here are all the different tools that are out there, including some that the advisor may never have heard of, right? In a way to actually deliver that service for the advisor, right? And ultimately for the end client. And I just find that when we think about advisors that are out there in the marketplace today, it's too much. Right? Like it's too much for them to try and keep track of. And, by the way, they don't want to keep track of it by just listening to whatever wholesaler walked into the office, right? Like they need to have a complete catalog of what are the available options, what are the right use cases, should I be using direct indexing, should I be doing this, should I be doing that, et cetera. As they think about that asset management decision, they need a guide for that. And as we think about institutional asset management, it's not just, like, oh, hey, Xerox the BlackRock model, that doesn't cut it, right? Like it needs to be like, let someone help you with a comprehensive knowledge of the various tools that are out there and guide you to what's the right solution for this particular client.
I love that. And, one of the buzzwords du jour right now, whether it's around technology or marketing or just, the overall advisor experience and leveraging technology, is personalization at scale. Like you can't turn around without bumping into personalization at scale, or hyper-personalization at scale, the cousin of the buzzword. Go ahead.
No. And it's one of these things. It's like if you're a one-trick pony advisor, right, that's only offering one kind of investment solution to your clients, the risk is that somebody comes along with the actual product that client should be using and picks them off from there. Right. And so it's really one of these things that, advisors have to kind of evolve on this scale.
So Patrick, thoughts on the buzzword du jour, hyper-personalization at scale, and how you fit into that new regime?
Sure. Yeah. I mean, and for us, it's, we think about institutional investment management as providing and empowering the RI community with the same front, middle, and back office infrastructure which exists in every major asset management firm around the globe, right? And so when you consider equity analysts and you consider all the CFAs and you consider all the various portfolio managers, right? What we would say is that by leveraging a dedicated tool set which is completely objective in its way of determining those alphanumeric characters, this coordinate-based system, in order to do this underlying research to find the similarity scores between different types of companies based upon different types of characteristics, right? What ultimately is able to be done with a system like this is someone could ultimately create a reductionist platform which mitigates the creation of a portfolio down to a few simple questions, right? And what we could effectively do is, go, through the same type of questions that I have asked every one of my major institutional clients in the past, and then just ask and answer that in a dedicated, simple, intuitive, easy to use platform. And so, at the end of the day, where we think it's ultimately going to go is, at a certain point, RIAs probably get sick of selling other people's products, right? I mean, and for me, I've built so many different companies' products that were white labeled and they didn't know we were ever even part of it, right? And these RIAs, they would come to us and they say, okay, well, I'm outsourcing to this sub advisor my small cap value, and they're charging me X, percent, right? And then I put on my X percent, right? And so the end asset owner is paying all these fees that are effectively duplicated, right? I mean, because you got the one sub advisor, they have all their fees with respect to transfer agency and custodial and legal and marketing and so on and so forth, right? And then you have the actual RIA who's using these people's products, right? And they have all their same fees: transfer agency, custody, legal, marketing, distribution, fund accounting, so on and so forth. And then the end asset owner is ultimately paying for this stuff not once but twice, right? And so over time, that has a huge negative compounding effect on the portfolio, right? And at the end of the day, you're still not even getting that hyper customization at scale because the sub advisor is doing what they do for everyone else, right? And so, what we think about hyper customization at scale is literally using a rules-based multi attribute classification schema to power a reductionist platform which automates the creation of portfolios, but as well as the ongoing management of them so that they stay true to the original investment objective in line with the stated rules of that portfolio's construction process. So that's how you would ultimately kind of bring that hyper customization at scale and make it economically viable through technology and data sets, and again, changes in custodial practices.
You basically sit down with a client, right, and say like, okay, for this particular client, do I want to be more aggressive, less aggressive? Do I want to be more leveraged to beta, or do I want to be less leveraged to beta? Do I want to be, more growth oriented, less, more international, less, et cetera? And you can see scenarios where, particularly for, I think as you start to get up on the wealth spectrum, right? You can see scenarios where you're like, okay, I've got a client that splits his time between, France and the United States or wherever it is. And so I want to incorporate, maybe some sort of currency hedge or something else like that, or exposures. I want to build that into the portfolio. To be able to then hand that off in a rules-based way to a software system and have it manage it for you at scale, once again, just gets wildly more cost-effective. And it's just interesting. Like, this isn't the first time that we've seen this sort of wave of fee reduction roll through the industry. I feel like we've been talking about it really ever since the ETF came on the scene, right? But there's still advisors out there that manage using, it's like, I was having this conversation earlier. It's like, you've got 8 different active mutual funds. When you peel the cover off every one of them, the client owns the S&P 500, right? Like, and you paid 75 basis points to get there, right? Because, and by the way, the data is pretty resounding that only 1 in 8 active managers actually winds up outperforming their benchmark. And if you think about the odds of having a 1/8 chance of picking one means to pick 8 of them in a portfolio that are all going to outperform their benchmark is like 1/8 to the 8th power. Right. So it's
that's how probability works.
Yeah, exactly. That's how probability works. So you see these portfolios where you're like, that business model seems very, very difficult, if we're honest. The business model where it's I'm going to sit down with a client, I'm going to create some, rules associated with that client's portfolio and then implement that for the client. That seems far more reasonable.
And now how sticky does that client become to that advisor?
So Rick and I joke about how both of us have this weird personality trait where sometimes we are in meetings and we see the meeting unfolding with the thought bubbles over the heads. And I've got the thought bubble and the cartoon image, the flames are starting to shoot up. I'm like, oh yeah, it's about to go down. We are talking about hashtag reductionist platform. Patrick, go ahead and claim that. You might as well start using it. This is exciting stuff. I want to circle back to tax efficiency, but before we do that, the journey that RFG has been on and taking advantage of building this portfolio was really solving a 10-year-old problem that you were facing, where advisors were coming to you over and over and over again with, my client wants to own single name equities, which we all get. Absolutely. You can talk about the emotional reason for that and the country club discussions and all the rest of it. And there was an opportunity for RFG to partner with Syntax to deliver what I believe is one of the most innovative and interesting approaches to get advisors out of the seat. Let me be very clear here. Advisors who are doing their own portfolio management and picking their own single name equity strategies and building that for clients on a one-off basis, or if they have a model, it's unusual, and not charging for it, or doing that for free. So how do we solve this opportunity to deliver clients a portfolio of single name equities and do it in a really cost-effective, scalable, personalized way?
Yeah. So it's really interesting, right? What we've done is essentially worked with Syntax to create a series of sort of rules-based equity index portfolios. We currently have a kind of a large cap growth, a large cap core, and a large cap value portfolios that are about 25 names that track those various indices, maybe have a little bit of tilts that we built in to kind of tilt juice one way or another, this and that and the other, but it effectively allows the data to drive that security set selection around, a very identifiable goal for the client. And we do find that advisors tend to skew either towards I'm a growth investor or I'm a value investor. And so being able to, offer that up depending on how their, honestly, it comes down to a little bit to personality.
Yeah, sure.
We want to be able to offer that in a way that gives the clients candidly, a very inexpensive single name equity option, right? And a way for them to, track the marketplace, et cetera. The other thing that you just have to maintain, and this is what it is. One of the things that we always struggle with at RFG is how do I bring institutional to retail, right? Particularly on the investment management side, because, right? It's great if you're a $50 million trust and you can say I can build a custom index for myself that has 400 names in it and there's no problem with it, right? When I'm instead dealing with, the local school teacher's $30,000 Roth IRA, right? I can't have 400 names, right? You can't make the math work on that. We need to get by with 20 or 25, and maybe not even that, depending on how these look. And so trying to take this sort of very tactical data around indices and breaking it down to something that you can use in a $25,000 account or a $30,000 account or a $40,000 account.
What about $1 million account?
$1 million account, great. You can still use it in $1 million account. There, we may introduce some other, like one of the problems with only having 25 names is you get a lot of tracking error in the account, and so you may want some ETFs in there to kind of bring things back to normal. But trying to work with the Syntax group to basically deliver a very cost-effective single-name equity strategy for clients that can be used down at the retail level, but then removes the advisor from actually having to do the work on it is huge.
And then on an ongoing basis, right, to maintain that that performance comparison to the overall market that you're tracking, right? I mean, I still remember when my dad showed me his portfolio years ago, and his advisor had him in 10 individual names. Each individual name was in a different sector of the U.S. economy, and then a bunch of buffered products and target outcome products, right? And we basically rebuilt his portfolio for him, and saved him a lot of acquired fund fees of mutual funds, right, while maintaining that same type of performance track record. So I fully understand the need to have ownership in the companies that control the ways and means of the United States economy and the global economy, right? It's something that you can kind of rest your hat on when you're sitting, again, when you're out to dinner, or you're at the country club and you're talking about your biggest stock performer of the week or the day or the month or the year, whatever it is, right? And it's to have the added insight into, okay, what's funny is that these companies do really well during these types of market environments, right? And so, to be able to kind of talk that one extra layer of, of granularity, by having that underlying data set, that's where, ultimately I think, the market will benefit the advisors who have that type of kind of conversational ability.
So, Rick, as you've had conversations with advisors who are, maybe have defined their value proposition for a long time as being a stock picker, or their clients are used to them, expect them to hold the reins on that, and they're handing it over to you in particular around these portfolios that you've built with Syntax. What are the objections, and how do they eventually get comfortable with making that decision?
So the objection that you never get over, right, is but I really like doing this, right? Like, I really like listening to the Delta earnings call, and I built my models for each one of these companies, and what I'm effectively doing is I wanted to work as a PM at Putnam or one of the other investment shops that are out there, but instead I found my way to the RIA space, and so I do that at very small scale for my clients, right? And that's the one objection that you never get over, right? Is I am really
I love it.
Yeah, I'm just this is my thing.
We all do it. We all like it.
But then, actually, a lot of people don't, believe it or not, right? All of the other objections are very, very easy to get over. My client has always, trusted me to do it for them. It's once again, part of our view of institutional asset management or investment management means that it's not you doing it anymore, but it is Rick and Patrick and Eric and Paul and the rest of this team, and you can see them and meet them and touch them. And so it's not like I just abdicated the investment management function. In fact, I'm collaborating with the advisor on exactly what it is that they want to own. If anything, we're just work sharing, not, it's not like you just abdicated all of your responsibility. If it's the benefits on the advisor's time are absolutely immense, right? Because let's be real, the advisor spends way too much time on investment management, which is not actually what drives the value of their business, right?
The data will tell you it's between 10 to 12 hours.
Yeah.
A week.
A week. And by the way, when you go to sell your practice, just so we're clear for the financial advisors out there, who I presume are the only people that listen to this,
and my mom,
yeah, and your mom. don't tell my mom. Anyway, like when you go to sell your business, like questions 1, 2, 3, and 4 are all going to be about like how many clients do you have? What's your average household size? How long have they been with you? How many of them have a financial plan? Like all of those sort of deep relationship things. And like doing your own asset management, 1 will be question number 50 on the list because no one cares. And 2, when they get to that question, if you answer in the affirmative of like, oh yeah, I do my own asset management, now it becomes a liability for the valuation of your business, right? Because it's like, oh goodness, well now we have to change investment management when you retire. So it's just one of these things where the only objection where there is not a like clear answer out there around how we can do it better for you. Oh, by the way, we can do it more cost effectively, right? Because investment management is one business probably more than any other where there are infinite economies of scale. Right? Like we have one trader on our platform that trades $3.5 billion. We've had one trader ever since we were a baby and had $120 million, right? And it's just like, it just scales, right? And the advisor can't scale effectively if they're trying to do it all themselves. And so we wind up actually delivering it more cost effectively for the advisor than the advisor could do it themselves. And so it's just one of these things. It's like, so long as you're not in that camp of like, yeah, but I just really love listening to the NVIDIA earnings call. Like, it's just my reason for being. If you're not in that camp, I promise you, I can make a more compelling argument around how we can do it more cost effectively. You'll grow faster. You'll have more time. Clients will actually get a better outcome than like we can tackle all of those with evidence and data in spades. It's really just the people that are like, no, I have to listen to these earnings calls because that's my reason for.
Patrick, I want you to touch on some of the work that Syntax is doing around compliance, client communication, helping the advisor to feel connected to, in our case, the way that we're building these single name equity portfolios so that they've got the talking points to be able to communicate to their clients and prospects.
Yeah. So everything that we do here at Syntax is grounded in rules-based and transparency with provenance back to the source of why we made the decisions we did. And, when Rick was talking about large cap core and large cap growth and large cap value, right, there's a 27-page document which outlines all the rules and procedures that go into that construction process and the ongoing the ongoing process there forward. That document touches on the data sources that we use in order to get to the results that we get, the days with which the days on which we do the particular processes in order to replicate it on an ongoing basis going forward. We've established, snapshot dates, effective dates, rebalance dates, right, where we basically have a schedule that we do things, right? And so that's how we're able to use an accurate a point in time construction process that would pass the muster of any regulatory body around the globe, which is in line with every major benchmark regulation as well as the IOSCO principles, if we kind of touch in on that. But at the end of the day, we have a team that kind of, and we've again been in the indexing business forever. And it's one thing to be able to create countless amount of portfolios and calculate them on an ongoing basis and deliver those portfolios, holdings, and weights directly to an order management system so that they could ultimately be investable. But it's a whole nother thing to be able to create effective commentary around what those portfolios are and how they're performing during different types of periods. And so one of the things that we've kind of been working on here at our firm is it's always a hot topic of AI, but what we've done is we've introduced our own version of an agentic platform where any one user can use our chat box and get the information directly from all of our various data layers and, again, our reductionist platform, in order to communicate why a certain company was included in the portfolio in the first place, why it was given the allocation that it was, why a company isn't in a portfolio that you might think it would be. And on top of it, you can say, well, how would this company typically do during different periods? Again, based upon our various data layers into the St. Louis Federal Reserve Economic Database. So what we've largely been talking about here is a portfolio construction assistant mixed with a portfolio research assistant, which ultimately provides the RIA community the same ability to go down the hall here and talk to any one of my 7 CFAs and say, why is this company doing this? Why is this company in this portfolio? Why is it allocated? Why is this company not in my portfolio? And at the end of the day, you're getting back a source data that hits all our various data layers. It's not going out to the general knowledge base, which is the internet, to construct or provide research, right? It's actually going into what we call our functional information system database, the St. Louis Federal Reserve database, right? All of our empirical market data, and says, this is why, these are the rules. This is why this company's in, this company's out, so on and so forth. So, we've been in conversations with, the SEC at my last firm, where we build custom portfolios, right? When the SEC was looking to, try to understand the role of custom indexing as it was evolving back in the 2010s, right? And that whole custom indexing business is one that we think we've kind of solved the scale problem, but it introduced a new problem, right? And the problem that introduced was, how can I actually communicate this portfolio to my clients, right? And this was a conversation that I was in at the last Technology Tools for Today conference last year. And, I spent basically a year with my team establishing, we have to build custom commentary based upon these custom portfolios, because an advisor is not necessarily going to have the time to research a custom portfolio for every single one of their clients, because every one of them is going to be different if you're actually doing that personalization at scale. So then what you ultimately need is commentary at scale.
Rick, talk about tax efficiency and tax optimization, both in the context of the work we're doing with Syntax, but also how that is such a fundamental hallmark of institutional investment management.
Yeah. So we'll take those in reverse order. If you're not at this point doing some type of tax optimization for your clients, you're really, I don't know what to tell you. It's not that hard at this point. Most software platforms will enable you to do that. Even if you're just doing an ETF model or something else like that, most software platforms will enable you to do, effectively trade tax efficiently. Because it's just a drag on net returns back to investors, right? Like that you should be managing on behalf of your clients. And, we can talk about the merits of, kind of a direct indexing product versus, something else. Sometimes I think, depending on the client situation, that those values can be a little bit overblown. There are some great use cases for it. There are some other use cases where you're like, I don't know if it's really worth it. But anyway. But I do think that if you're not at least for every client that has a non-taxable account doing some very basic tax management for the client, then you're just leaving dollars on the table that you really shouldn't. And so it's part of everything that we do is tax management of every account that we look at on the platform. And then obviously, for a firm like Syntax, where we're creating 25 different securities or even a 50 different security portfolio, that's going to create the possibility for more tax efficiency. The more positions you have, the less diversified each one of those positions is, the more likely that you're going to have a position that's in a loss at any given time. And so the easier it is to be able to go in there and sort of tax optimize those portfolios. And so that's the work that we do with Syntax on, just making sure that we're staying on top of that on behalf of the client.
Was there voodoo magic involved in selecting adjusting the number of holdings in those single name equity portfolios, or how did the two of you collaborate to determine what that was going to look like?
Well, so it's a math problem because, one of the things that you always deal with as you're dealing with single name equity portfolios, and by the way, this is just the retail marketplace in which we live, right? But if you're trying to track the S&P 500 and you're able to use 100 or 150 names, you can get your tracking error down really, really tight, right? Like it'll pretty much just track the S&P 500, right? If you're trying to do it with 25 names, all of a sudden that tracking error starts to expand pretty dramatically. And so and by the way, it's almost geometric in the way it expands, right? The fewer names I have, you almost square the standard deviation as opposed to just linearly increasing the standard deviation. And so we worked with Syntax on, okay, what's that right optimization of names to try and deliver low tracking error, but then also get the total number of names down to a size where it would be digestible for most of our clients, right? And 25 names is something that you can squeeze into a $50,000 or $60,000 portfolio pretty easily. If you're talking about 50 or 100 names, it's not going to fit, because you have individual securities with greater than $100 trading price. And we can't buy fractional shares. So, it really is.
But are you solving a problem only for a small account with this solution, or?
No, because if you wanted, like in my mind, there's a couple different use cases. If you've got a larger account that wants more of a custom index solution, that is not hard to deliver, right? Like we have a lot of different products on the platform that can deliver that type of thing, right? And so that's not difficult to do. Where I think it is difficult to do it is single name equity portfolios managed at scale for smaller account sizes at a cost-effective price point. Right? Mm-hmm. Because, everything else in the industry tends to be, starts at like 30, 40, 50 basis points to try and deliver that type of thing on a good day. And, we're sub 20 basis points in delivering this.
I just want to come back because advisors will hear this and think, all right, the biggest problem I'm trying to solve, quite honestly, is not my $30,000, $40,000, $50,000 account. The biggest problem I'm trying to solve is my $1 million client. Like, how do I deliver to them a portfolio that has single name equity as a part of it, and then I wrap, as you said, some other strategies around that. So I just think it's important to kind of, that's when I look at a lot of the clients that are invested in these portfolios, they are larger accounts. So just walk us through how this is blending in.
I mean, it's a mix. You got to be able to solve problems for all of the clients an advisor has, or at least the vast majority of the clients that an advisor has. If an advisor is adopting an investment strategy like single name equities or something else like that for only 3 or 4 of their clients, then it's not scalable for the advisor, right? Like, we always talk about you do want some degree of standardization across all of the portfolios that you manage so that when you start to go into and by the way, right, customization at scale, personalization at scale, but you do need some standardization underneath it so that every review meeting that you prepare is not a like, oh my God, I have to have 100 different review preps, right? I want to have one review meeting 100 times, not 100 different reviews, right? And so, we do want to build a scalable option where it's like, yeah, for all the clients above $50,000 in size, this is, some flavor of this is what my toolkit looks like. Because only designing a solution that works for the top 3 or 4 clients in an advisor's portfolio is also not effective. It's not effective for the advisor. It's not effective for us. And so we did want to make sure that whatever equity portfolios we put out there, whatever single name equity portfolios we put out there were usable at scale for our end of the market. Right. Yeah. Believe it or not, solving investment problems for the $3 million client, not a hard thing to do. There are a lot of people that will do that for you. Solving investment problems for the $50,000 client is a much more difficult problem.
So, Patrick, one of your favorite soapboxes to stand on is the future of asset management in a more cost-effective delivery mechanism. The floor is yours. What does that look like?
So one of them, for me is I was at I was at a conference last year, and great conference, and but they kept talking about the additional share classes for ETFs. When you think about when the ETFs first came out, right? They were effectively challenging the conventional 40 Act mutual fund space, right? I mean, and why did people move to ETFs? Obviously the tax efficiency for the in-kind redemptions and contributions. You can increase shares of the ETF, and you can redeem shares, right, the ETF, and do it tax efficiently because all of the tax consequence takes place outside of the trust, right? Um, and what it did is it lowered the investment minimum, right? Because now they're traded on a per share basis as opposed to a per unit basis that had, a minimum investment. And the mutual funds, at a certain point, they had they had loads, they had no loads, they had 12B5 there, they had the 12B1 fees, they had different institutional share classes, right? There was a I share, there's an F share, there's a J share, so on and so forth. And each one of these shares have different expense ratios. And those expense ratios are all more or less dependent upon the minimum investment, right? So, when Rick's talking about, a 25 stock portfolio and managing that for a $50,000 account, right? The reason why it's important is because what you're effectively looking at is, the weight of any one given company or the stock price of any one given company divided by the weight that that company represents in a portfolio, right? You do that across the whole portfolio, and whatever that largest number is in that column there, that's the minimum investment that you need in order to replicate that portfolio really, really tight, right? And so, these different institutional share classes have, a very low expense ratio, and then you have different standards for different minimum investments. And then the ETF came out, and you can just put $5 in the ETF, right? You can just buy a single share of the ETF, whatever it is, right? Whatever the stock price is. Normally they launch at $25 or $40, right? It's all dependent upon what's seeded, how much is seeded the ETF, right, and the number of shares and the creation unit, right? And so at the end of the day, by introducing additional share classes to the ETF industry, what's ultimately happening is the ETF industry has matured, and it's good. It's really great that it did. But now what it's doing is it's taking the legacy pricing model of the conventional 40 Act mutual fund space and bringing it to the ETF space, which is now showing ETF investors that there's different classes of investors in the ETF. All the same underlying holdings. You invest in the 500, you still get the same 500 holdings, right? You invest in a 30 stock portfolio, you still get the same underlying holdings, but one institution is paying less because they invested more, right? And so where we think the ultimate future is going, it should be the opposite, right? Because obviously the people that have the less money need more money, right? And so what we should be thinking about is solving that problem using technology, right, and custodial practice differences in custodial practices. And so what we think is ultimately the future is the $100 investor is the same as the $1,000 investor. The $1,000 investor is the same as the $100,000 investor. This $100,000 investor is the same as the million, and so on and so forth, all the way up into the billions, right? I mean, at the end of the day, if you're automating portfolio construction and ongoing management optimized to a given investment objective, why would one person have to pay more than someone else because they have less money to invest, right? And so, if we think about how technology has, kind of surfaced in all the various other industries of our economy, finance is one where it's kind of on a lag, right? And so, our main mission here at Syntax is to bring again, that same front, middle, and back office infrastructure that exists in every major asset management firm around the globe and put that into the hands of the RIA community so that they can stop selling other people's products and they can start selling their own.
I mean, boom. I love that. That's so good. It's so good. And there's just a really interesting story arc in there, the way you laid that out, Patrick, of the mutual fund to ETF evolution, and then the ETF evolution, I would say de-evolution, devolving back, as opposed to becoming more cost effective, more personalized, leveraging technology. So feels like we've got a little bit of a, rumble on our hands.
Well, why do you think that is, right? Because in order for ETFs to continue growing, they have to create vehicles to move mutual funds into ETFs, right? And so what's ultimately happening is they're taking that same way where, I have all these different mutual fund share classes. So if we could do that in the ETF business, my ETF business can keep growing, right? But it's the technology is the future at the end of the day. It's not going to stop.
Yeah. Any other thoughts you'd like to close us out on in terms of what the future of asset management looks like, or how you're thinking about the points that Patrick has laid on the table of being very cost aware as you build institutional strategies for our advisor partners and their clients?
Yeah, I think that, clients are very focused in on this issue, right? Like, clients generally are aware how much they are paying for services. And there's a certain fee level at which, I don't think the clients squawk too much about, right? Like, I don't think anybody's going to get too upset about if my, ETF is 20 basis points versus 15 or, whatever it might be, depending on the style of management. But I do think that there is this drumbeat of, and rightfully so, like, how do we get more efficient as an industry delivering better investment management products to our clients? And we're all profit motivated, but at the same time, we want to get more efficient in the provision of services and ideally deliver a better result to the client. And that's what you're trying to drive through, customization and scale and, partners that help you do it for you, et cetera, is all about driving just that efficiency and better. It's less expensive and it's better. So, trying to drive that through to the end client is always going to be the drumbeat in our industry. And, I think this is just the next step in the evolution of it.
And I think for us, one last thing, put a bow on it, as the premier destination for independent advisors who are looking to build their business, who are younger. Our advisors skew younger, 45 years old, thinking in terms of decades in front of them and serving a vital role in this generational wealth transfer. I think we are very comfortable, like, righteously planting our flag in the ground that there's never been a better time to be independent, to build enterprise value, to show up and deliver an exceptional client experience that is values aligned and highly differentiated, meeting your clients and demonstrating to them what they seek in you is unique, and helping them to tap into institutional caliber investment management is just an absolutely essential piece of the formula for creating enterprise value, for driving organic growth, for driving the satisfaction scores up, and delivering something really special to the end client. Patrick, where can people find you and learn more about how Syntax can lead the way for, let's call it, the reductionist revolution?
Yeah, it's funny. The reductionist, it actually has a meaning. And so syntaxdata.com, syntax, SYNTAX data.com.
And, Patrick's obviously on LinkedIn. And, if you need his email, hit me up. Awesome. Great to be with you all.
Thank you, Shannon. Appreciate it. Thank you, Patrick.
Bye, Patrick.
Thank you for listening to the Disruption Blueprint podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.rfgadvisory.com or schedule a call on our advisor resources page. And don't forget to click the follow button to be notified when new episodes become available. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice, nor is it a recommendation to buy, sell, or hold any specific security or engage in any specific trading strategy. Information here may be provided in part by third-party sources. These sources are generally deemed to be reliable. However, neither our guest nor RFG Advisory guarantee the accuracy of third-party sources. The views expressed here are those of our guest. They do not necessarily represent those of RFG Advisory, its employees, or its clients. This commentary should not be regarded as a description of advisory services provided by RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Securities offered by registered representatives of Private Client Services, member FINRA SIPC. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Private Client Services and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place. RFG Advisory is an SEC-registered investment advisor. SEC registration does not constitute an endorsement of RFG by the Commission, nor does it indicate that RFG or any associated investment advisory representative has attained a particular level of skill or ability.